Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. Happy Tuesday. These are the stories that set your agenda. Chips to China. Nvidia says it is resuming sales of its H20 AI semiconductors after the Trump administration U-turns on restrictions. Chinese GDP growth comes in better than expected, but strong exports mask more weak readings from the country's consumers. Plus, Donald Trump threatens 100% tariffs on Russia, giving Vladimir Putin 50 days to end the war in Ukraine. So a dramatic U-turn from the Trump administration in terms of those export controls. So we watch the tech sector and, of course, Nvidia pricing pre-market and the impacts of that. A surprise turnaround in terms of the Trump administration's thinking about those export controls. European futures pointing higher by 0.3%. President Trump says he is open to conversations with the EU on trade as we count down now to that new deadline of August the 1st. FTSE 100 futures currently pointing to gains of 0.2%. The upside, of course, year to date for the FTSE 100 close to gains of almost 10%. The retail sales data as well out overnight, suggesting that maybe things are starting to turn around in terms of this UK economy. We have the Mansion House speech from Chancellor Rachel Reeves later today. S&P futures stateside looking to gain 0.2%. Nasdaq 100 futures with the Nvidia story central to that, pointing higher by 0.4%. Let's flip the board and have a look cross-asset. In terms of sovereign debt and fixed income, a lot of action there. 3 straight days of losses for the 30-year in the US. The 10-year at 4.43. Yields continuing to edge higher in terms of the last few days. And you're seeing that reflected in the Japanese session as well, with JGBs in focus. Pound at 134 on that data, just currently up a little under 0.1% for sterling. Brent at $68, just close to $69, down 0.4% on oil. Those threats, of course, around Russian supply in focus with Trump's tariff and sanction proposition for Russia. And Bitcoin back below 120,000, off 2.2% so far in the session. Let's check in on the Asian markets then. JGBs, the 10-year in focus, yields at the highest level since 2008 on expectations that maybe you'll get more fiscal spending. And that is part of the concern leading to that continuing bond rout over in Japan. There's the JGB 10-year at 158. Broadly across the equity space in this region, MSCI Asia Pacific up just 0.1%. The GDP data broadly stronger out of China, of course, but there are continuing concerns about house prices and the consumer. The CSI 300 down 0.4% on mainland China. HSI over in Hong Kong currently up 0.2%. Now to earnings, and Ericsson, of course, the telecoms equipment maker, coming through with some top lines for this earnings season. Ericsson's second quarter net sales coming in at 56.1 billion Swedish krona. That is below estimates. It's a miss then for Ericsson. The estimates had been for just above 59 billion Swedish krona. In terms of second quarter adjusted gross margin, that is a modest beat. So gross margin coming in higher than expected for Ericsson in the second quarter, 48%. The estimates had been for 47%. In terms of earnings before interest and tax, you're looking at a print of 7 billion Swedish krona. That is also a beat above the estimates for Ericsson. There have been some concerns about weak dollar and the impacts on their sales in the US as a result of that squeeze on the dollar. So Ericsson will be one to watch in the session today. Back to the chip space right now. Nvidia saying then it expects to resume sales of its made-for-China H20 artificial intelligence accelerator based on assurances from Washington that those shipments would be approved. It is a dramatic reversal from the Trump administration's earlier stance. The H20 chip was created to comply with earlier trade curbs, but since April has also been blocked from sale in China. Bloomberg's chief North Asia correspondent Stephen Engel joins us now for the details. Stephen, what more do we know about this Nvidia announcement and what it tells us about the Trump administration's thinking on export controls?
Well, I think it's interesting that it was Nvidia who announced this, not the White House. I'll get to that and what that means in a little bit. But essentially, this is a great victory for CEO of Nvidia, Jensen Huang, who, by the way, is in Beijing right now, just appeared on state television. And we learned of this development on the H20 chip through a blog post from Nvidia, essentially saying that they've been given tacit approval by the White House to apply for those export licenses for the H20 chips to be sold to China. And he expects, Jensen Huang and Nvidia all expect that those license applications to be approved and the H20 chips can resume being sold to China. Jensen Huang has been an outspoken critic of these export controls from the United States, saying they haven't worked, and also they've given competitors in China like Huawei an unfair advantage. In fact, Nvidia projected they could lose about $8 billion in sales in this current quarter just because of those export controls. They'd also been working on a new chip based on Blackwell architecture to comply with those Trump trade curbs. But now, if the H20 is going to resume sales to China, it would be an interesting development, obviously, and a very fortuitous one for Nvidia to have two potential chips. Yes, they're scaled back from the most advanced AI chips from Nvidia, but still, having chips that are compliant with U.S. export controls allowed to go into China is a big development, not only for Nvidia, but for U.S.-China relations, no doubt.
Well, on that point, Stephen, what is your assessment of what this tells us about those conversations, the trade tensions that we know exist between the two sides, that on some level have eased to some extent? What does this reflect when it comes to those trade negotiations?
Well, it tells us a lot about what Jensen Huang and Donald Trump spoke about in the White House last week, and also why Jensen Huang is in Beijing right now with meetings with the Commerce Minister as well as their trade negotiator, He Lifeng. So obviously he's the one that has lobbied the White House, gaining that approval for the export licenses, and he's the one to take that message essentially to China. What it tells me about the backroom bargaining in the trade deal and the trade truce that was reaffirmed in London is that the United States clearly wants China to speed up its export licensing process for rare earth minerals as well as rare earth magnets. And what does China want? They want a relaxation of those tight export controls on advanced chips. It seems as though this was win-win for the two countries as they try and bridge their differences. And this was maybe for Donald Trump, as he met with Jensen Huang, a little bit of a low-hanging fruit and was convinced that they're doing the United States tech companies' competitive advantage more harm than good.
OK, the broader context then to this apparent U-turn on these AI accelerators produced by Nvidia being shipped into the Chinese market. Bloomberg's chief North Asia correspondent, Stephen Engel, thank you very much for that update. Staying on China, the economy, of course, there grew more than expected in the second quarter, driven by strong exports. But the data also showed weak consumer demand at home. Let's get more from Bloomberg's China economy and government editor, Alan Wong. Alan, talk to us about exports and the role that that pillar of this economy is playing and whether or not it can be sustained in the months ahead.
Certainly. Well, China's factories went humming in the first half of the year. And despite all the tariffs from the U.S. and all the potential trade barriers coming from other economies as well. So they did hold up the economy and help the economy achieve greater than 5% growth in the first half, and with last quarter's growth exceeding expectation. This means that China is on track to hit its around 5% growth target for the year. But as you suggested, the factors behind China's export growth and very strong industrial production, which, by the way, exceeded all expectations, it could be temporary or contingent upon other trade partners. For example, a lot of that export was driven by front-loading, which is how exporters rush their shipments out the door just to avoid tariffs. And with the tariffs just settling at some rate in the near future, or maybe in the distant future, that kind of front-loading is expected to fade. And the other thing that could be under threat is trade diversion, which is how China is shipping more and more to Southeast Asian countries to get around tariffs imposed by the U.S. So Trump has signaled that he wants to address that kind of transshipment and put higher tariffs on them, however he does it. So if he succeeds, that means that China's export to those places could be affected as well.
OK, so some of the caveats then around the headline number on GDP. What are the challenges then, Alan, for China as it squares up to the second half of the year, given all those wrinkles in the data?
The data tells us a lot about what happened in the last quarter and a lot of new developments in industrial production and exports, mainly how strong they have been. But what hasn't really changed is the underlying weak demand domestically. We're seeing retail sales came in lower than expected and below the magical 5% number that China's economy is officially supposed to hit by the end of the year. So which means that despite the Chinese government subsidies for purchases, local consumers, they're not still spending a lot, and they're still wary of spending too much, mainly because they have a very dim outlook for their income, and the domestic economy strength is still in question locally. So that means that going forward, there might still be a lot of price pressures, and the demand is still weak, and China will be reliant on factors that are vulnerable to external pressures.
OK. Excellent update in terms of the data that crossed on China's economy and what to look for as well. Some of the challenges going into the second half of the year for the world's second largest economy. Bloomberg's China economy and government editor Alan Wong with the context. Alan, thank you. To Japan now, and this tells a broader story in terms of appetite amongst investors for sovereign debt. The yield on 10-year Japanese government bonds has hit the highest level since 2008. Let's get the details from Bloomberg's Valerie Taitel. So, Val, it's not just the super long bonds that are under pressure now. This has moved to the 10-year. The sell-off is expanding, it seems.
Yeah, that's right, Tom. The sell-off is expanding, now hitting the 10-year sector, and that's more important for the Japanese economy. It's a lot more sensitive to 10-year yields than it is those 30-year and 40-year yields due to a lot of mortgage products tied to the 10-year sector. So this could have a real impact on Japanese GDP growth. The kicker for all of this is worries about fiscal spending. The upper house elections are due to take place this Sunday, and the market is clearly worried that more fiscal spending is to come, and we're seeing this kind of reaction in the long end of the bond market. Not only did 10-year yields reach the highest since 2008, but those 30-year yields, Tom, have reached the highest yields ever since their debut in 1999. So we're seeing some pretty cataclysmic effect when it comes to these JGB yields. We're also seeing a deterioration when it comes to the liquidity. If you flip on, we do have a Bloomberg index of Japanese government bond liquidity. This spike higher is showing you that liquidity is deteriorating. And this is despite the Ministry of Finance saying they're going to issue less long-end bonds. This is despite the Bank of Japan reallocating their tapering away from the long end in order to aid this liquidity, but it's really not having any effect. We also are seeing this have a global impact. Take a look at long-end Treasury yields. We're coming very close to that 5% level. It's also having an impact on European government bonds. The German 30-year bond hit the highest since 2023, all on the back of these Japanese bond moves. OK,
this is a global story with global ramifications. To the US and inflation data, Val, out later today. Pretty consequential in terms of how we think about the Fed's reaction function and that tariff impact. Yeah, that's right. A lot of investors will be looking for tariff pass-through in this inflation print today. It's not expected to have a big impact on the pricing for the Fed's meeting in July, but it might be more consequential for their meeting come September. We are expected to see a broad rise in CPI. Both headline and core are expected to tick up, both on a year-on-year basis and a month-on-month basis. But what's going to be really important is taking a look at these specific sectors that are exposed to tariffs. We can flip on. I can just name a few of them. These are a few that investors will have their eye on. But the real key here is if we see a broad-based, higher than expected CPI in core goods, that might be the beginning hints that retailers are becoming more comfortable passing on higher prices to consumers, and might be the first hint that inflation could be broad-based and more persistent than believed. OK, Bloomberg's Valerie Taitel with a preview of the CPI data. Markets squarely focused, of course, on that print, which will be across the terminal. We'll be breaking down the context for you, of course, later today out of the US inflation data. Here's what else to be thinking about today, then. US bank earnings kick off with JP Morgan, Wells Fargo and Citi. We will bring you those lines, of course, as they drop from the banking space. And at 1:30 p.m. UK time, that is the US CPI print that Val has just previewed for you. And at 9 p.m. UK time, The Chancellor, Rachel Reeves, will give that Mansion House speech, her first public speech since, of course, she moved the markets with her own tears in Parliament on that day of high intensity, of course. So the Mansion House speech, and we will be across that for you, of course. You can get a roundup of the stories you need to know to get your day going. In today's edition of Daybreak, terminal subscribers can go to DAYB Go on the terminal. The U-turn around the Trump administration's export controls on Nvidia is front and centre. Coming up, President Trump threatens Russia with 100% tariffs if there is no end to hostilities with Ukraine. The details on that are next. Plus, later in the show, I'm going to be joined by Investec economist Ellie Henderson to look ahead to the UK Chancellor's Mansion House speech this evening and get some views in terms of how she thinks the Bank of England will be responding to the data and inflation story out of the UK. Stay with us. That is coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. US President Donald Trump has threatened to impose stiff financial penalties on Russia if it does not end hostilities with Ukraine. Trump said the levies would come in the form of secondary tariffs.
But we're very, very unhappy with them, and we're going to be doing very severe tariffs if we don't have a deal in 50 days. Tariffs at about 100%. I'm disappointed in President Putin because I thought we would have had a deal 2 months ago, but it doesn't seem to get there. So based on that, we're going to be doing secondary tariffs if we don't have a deal in 50 days. It's very simple. And they'll be at 100%. And that's the way it is.
Well, joining us now is Tony Halpin, who leads our Russia economy and government coverage. So, Tony, Trump ratcheting up the pressure on Russian President Putin. Talk us through what we've been hearing from the US president in what seems to be a pretty significant U-turn in terms of his stance on Russia.
Yes, morning, Tom. Yes, President Trump was expressing clear discontent with President Putin yesterday. I think he said at one point that he thought he had a deal 4 times in the last 6 months, but they never seemed to get it over the line. So he's reacting now by saying he's going to target the sources of Russian financing of this war, essentially countries like China and India that buy Russian oil and help Moscow pay for its war. But the silver lining from the Kremlin's point of view is that this is all going to happen in 50 days' time. So from a Russian perspective, it may be an invitation, in fact, to intensify its campaign on the battlefield to try and make as much progress as possible in that window. But Trump clearly was most disappointed in Putin yesterday, and he made that displeasure clear.
On the financing of this, because there was also a commitment, Tony, wasn't there, for more military hardware for Ukraine, alongside the threat of sanctions or tariffs on Russia. But a real emphasis from President Trump that the US would not be paying.
Yes, that's right. He's shifted the burden onto European nations to pay for the weapons that Ukraine needs. And on the one hand, of course, that's a clear shift from the policy of President Biden, who supplied weapons to Ukraine directly. But on the other, for Ukraine, it was a reassuring thing because they were very concerned that US weapon supplies might be interrupted or delayed once the Biden package ran out. And now they have at least a clear way to get weapons. They know that they have to pay for them. They know that European allies have to pay for them and to supply Ukraine with the weapons. But they can be sure that they will get US weapons to help defend themselves against Russia. And over the horizon, as you said earlier, is this risk and the threat for Russia of 100% secondary sanctions that would potentially target its financing of the war. So there's a squeeze coming. It's just delayed by 50 days, I think. And in the meantime, Ukraine will hope to get hold of the weapons it needs to defend itself and to continue to repel Russian attacks.
OK, another deadline, another countdown, this time when it comes to geopolitics. Tony Halpin, who leads our Russia economy and government coverage. Tony, thank you for that update. Now, some other stories making the news this Tuesday. Israel has launched attacks in southern Syria after deadly clashes involving the Druze community. The Israeli army says it struck several tanks advancing towards al-Suwaida province, saying it's a clear warning to the Syrian regime that Israel will not allow the Druze to be harmed. The London-based Syrian Observatory for Human Rights says the clashes killed about 100 people. Syria's defense ministry says government troops were deployed in the region to end the violence. Officials from the European Union are to hold talks with Elon Musk's X after the company's Grok chatbot caused outrage by making anti-Semitic posts last week, including praising Adolf Hitler and the Holocaust. The company deleted the offending posts and apologised, blaming a faulty update. Coming up, Wall Street's largest lenders begin reporting earnings today, with JP Morgan and Citigroup first on the list. We were going to preview the bank earnings. That's coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, the European Union has finalised a list of countermeasures to target US goods worth 72 billion euros, including cars, Bourbon and Boeing aircraft. The measures represent the EU's response to President Trump's earlier so-called reciprocal tariff. Bloomberg's EMEA News Director Ros Mattson is here with the details. Ros, what do we know then about the EU's countermeasures?
Well, as you were saying, they've finalised this list of countermeasures. This is actually cut down from the initial list, which was over 90 billion euros, but it does include some essential items, including targeting Boeing, particularly in the aircraft side, Bourbon, everything from medical equipment to plastics to agricultural equipment to musical equipment. It doesn't include military equipment, which would not be subject to any tariffs from the EU, but it is about sending a message to the US that the European Union is prepared with very specific measures targeting certain US goods in the event that this all disintegrates and there isn't a deal before the 1st of August. And some of these items that they're targeting very much with an eye to the US midterm elections even. You're thinking about Bourbon, some of the states where Bourbon comes from in the US, can they be key states in the US midterm elections for those companies and therefore for Republican politicians as well? And the message in all of this is that the EU wants to keep negotiating. Certainly we're seeing that happen. The impetus is to try and get a deal. They do want to avoid a broader trade conflict with the US. Certainly European companies want to avoid a broader trade conflict with the US. However, they're warning the US, we are prepared. We have a specific list of things we're going to enact if we have to. We need to have all options on the table.
What are the current expectations, Ros, that maybe there is a deal by August the 1st between the EU and between Washington?
Well, the climate's become a bit trickier because Donald Trump keeps referring, to his letters as deals. These are not deals. This is the US imposing a tariff rate on countries or blocs, including the EU. And negotiating in that climate is quite difficult because you're trying to address very complex issues, not just tariffs, but non-tariff barriers that are seen as existing to trade. Very complex conversations going on about sectors for the EU, steel, aluminum, cars, you name it. And so you need to have a bit of a climate of trust going on there. I mean, Donald Trump said yesterday he's willing to keep talking with the EU. Certainly we know that the chief negotiator was on the phone last night with the US Commerce Secretary, so those conversations are going on. But they're getting to a deadline now of August the 1st. That's the fresh deadline. And there's a lot, it seems, to wade through. And so the EU is quite wisely saying, well, we have to have a lot of issues in our back pocket, including these potential countermeasures.
OK, and certainly the markets will be hoping that those countermeasures are not put to play, but the EU has them, at least in their back pocket for now. Bloomberg's EMEA News Director Ros Mattson with the latest on the trade front and the potential EU response. Ros, thank you very much indeed, leading up our EMEA coverage. Coming up, we will look ahead to the UK Chancellor's annual Mansion House speech with Investec economist Ellie Henderson. That is next. This is Bloomberg. morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Chips to China. Nvidia says it is resuming sales of its H20 AI semiconductors after the Trump administration U-turns on restrictions. China's GDP growth comes in better than expected, but strong exports mask more weak readings from the country's consumers. Plus, Donald Trump threatens 100% tariffs on Russia, giving Vladimir Putin 50 days to end the war in Ukraine. The market's then getting some relief as we count down to inflation data out of the US. The Nvidia story front and center right now, with some of the tech stocks over in Asia getting a bit of a lift on this apparent U-turn from the Trump administration in terms of these export controls. European futures up 0.3%. President Trump says he is open to continuing negotiations with the EU as we count down to that new deadline on trade of August the 1st. FTSE 100 futures up by 0.2%. We're counting down, of course, to Chancellor Rachel Reeves' Mansion House speech. The retail sales data slightly stronger out of the UK overnight. S&P futures looking to gains of 0.3%, and Nasdaq 100 points in upside of around 129 points, and Nvidia will certainly be part of that story. Let's flip the board and have a look cross asset. You've seen continuing selling pressure across the long end of the bond space, with the 30-year in focus in terms of US Treasuries. 3 straight days of losses. The benchmark 10-year at 4.43, largely unchanged. There's some stability in the Treasury markets right now, but the 30-year is closing in to 5%. The pound at 134, a little higher by 0.1%. Brent just below $70 a barrel, down 0.1%, with the threats around Russian supply in focus for traders, of course, and Bitcoin falling below that 120,000 level it crossed yesterday, down by 2.2%. So, to the UK then. Chancellor Rachel Reeves will make her annual speech to London's financial industry later at Mansion House. It is, of course, a key moment for the sector, but also for the Chancellor herself after the recent market jitters over her future. Bloomberg's James Woolcock joins us now for a preview. James, what are the key announcements then that we should be expecting, that the financial industry, the financial sector, the City of London should be looking out for from Rachel Reeves later?
Well, look, the Chancellor wants to do 3 things here. First and foremost for her, she's saying that she's still here. She's the Chancellor, she's not going anywhere. And after the recent fiscal sort of rocky period of her sort of in this Parliament crying, that's not happening. The second thing here is there is going to be what I'm calling Mansion House tapas, where we're getting lots of small plates. We're seeing a concierge reforms potentially, talks about potential reforms to how the financial ombudsman works. ISA changes were mooted, but seem to have come back off due to pushback from the sector, and even stuff like capital insurance is being mentioned. Lots of little things that we won't really know the effects of until we see the details, but are designed to keep the city happy. But the third thing is, especially after the welfare U-turn, we're going to be seeing a pitch to make this more retail. A lot of the reforms are going to be announced in Leeds earlier this morning, ahead of coming to the City and Mansion House this evening. And in the kind of Treasury trail, people have been talking to me have been saying this is all about dialling up risk to allow more mortgages for homeowners. So that pitch from taking from the city out to the wider UK is going to be a big thing that Reeves wants to show. OK, so she's in Leeds first, then she comes to the City of London for that tapas offering for the City of London. You nodded to this, James. How significant is this moment personally for the UK Chancellor? She needs to show that she has business backing and the city's backing, which is something that she has made great pains. If you remember the smoked salmon offensive pre-election of getting the city on side. Now a lot of the city are looking at the fiscal worries. They're looking at the autumn and saying, we see taxes coming down the line. We wonder if we might be on the hook for those. And they're saying to Reeves, show us that you're really a Chancellor who wants the financial sector to grow. Show us that you can make that happen. And this is the moment where we see what Reeves is really made of. The Treasury are calling this the biggest reforms of a decade. Let's see what's in the detail. OK, James Woolcock, thank you very much. Indeed, setting us up nicely for the Mansion House speech, covering UK politics for us. Thank you. Let's bring in another perspective right now with the focus on the economics of the UK with Ellie Henderson, an economist at Investec. We'll also get views as well on the US inflation story and the Fed. But Ellie, let's start in the UK then. What are you and the team looking for when it comes to these Mansion House reforms and what we're going to hear from Rachel Reeves, the Chancellor? Where is your lens? Where is your focus?
I think I like that saying about it being a tapas of measures, and we think broadly the same, but I think that all comes with one underlying message, which is to boost investment in the UK economy, and that's really central to Labour's plan for growth. Of course, though, if it was that easy, everybody would do it, but it's centred to Labour's plan, and that could get Labour out of the potentially tricky situation with the public finances if successful. But ultimately, this is a very difficult time for businesses, and surveys aren't suggesting a great appetite to invest right now.
OK, so the investment story still needs to be filled out for this Chancellor and for the UK. What are you seeing in terms of the data? We had the retail sales data dropping overnight, suggesting a slightly stronger June. Weather seems to have been a factor there. Are we starting to see some green shoots for this UK economy, where, of course, we've had 2 straight months of contraction?
Yeah, we had the GDP data last week, which showed that, as you said, the economy contracted for the second consecutive month. Part of that was a weak retail sector, but we think that over-exaggerated the weakness in the sector, and it was really a payback from previous months where we've had some very strong gains. And as you said, we had the BRC retail sales data overnight, which was strong. Part of that was the weather. Part of that was the BRC measure is not adjusted for inflation, and food prices are rising, and that boosted the figures as well. But we're hoping that some more momentum is coming into the UK economy, but it is still a challenging operating environment for businesses.
What about the labour market? Are we starting to see significant cracks in the UK jobs picture?
There are some signs that we are having a loosening in the labour market from what was a very tight stance. The difficulty is, as is full well known, that the ONS data isn't particularly reliable at the minute, but the Bank of England is relying on a whole host of measures, and the labour market does seem to be a key focus for committee members. You only have to look back to the minutes from the last meeting to see that the labour market was the prominent focus of those minutes, and we've had comments from different speakers, including Governor Bailey himself, that they are watching that survey data very, very closely.
Where do you and the team then see BOE rates by the end of this year? What are the next steps for this Bank of England?
We think the Bank of England will continue with its key narrative that it has since it started this easing cycle, that it will be a gradual, careful approach to easing, and that involves a hold-cut approach to easing. So that ties it up for another 25 basis point reduction in August, and then we think there'll be one further one by the end of the year, leaving the bank rate at 3.75%. But crucially, the Bank of England wants to keep all options open on the table, and if that labour market does deteriorate, then it has the option to reduce rates at a faster pace.
OK, 3.75% by the end of the year. This is not a Bank of England that's behind the curve, you think?
No, we think it's broadly in line with market pricing. Where we're a little bit different from market pricing is on next year's rates. We think that the bank rate will end next year at 3%. That's lower than the market curve, but that's where we broadly put the neutral rate, and we think the bank will keep on going with its hold-cut approach until it reaches it.
To the US, we get inflation data out of the US later today. What does recent history tell us about the lag between tariffs being implemented and how that shows up and when that shows up in inflation?
A common example is looking back to 2018 with the washing machine saga, when tariffs were put on washing machines, and it took about 2 to 3 months to that show up in the hard data. So if we extrapolate that to today's data, I think there's expectations that we'll start to see the first signs of tariff impacts in the data. So for economy watchers, this is a very exciting print, maybe not to the US consumers, which will see prices rise, but American businesses have consistently been telling us that price rises are coming.
Do you expect that to keep the Fed on the sidelines?
I think the judgment really is this a one-off price increase or a more longer lasting? And here there does seem to be some disagreement on the committee. You've got the likes of Waller and Bowman who are saying, look, it will be a one-off rise. We can continue cutting rates. And then you've got some other members of the FOMC that are more concerned that this will be longer lasting and probably quite scared of that whole transitory fiasco that we had.
The T word. What's your view? I mean, you're right. This is a live debate in terms of whether or not this passes through and is one-off or is something that is more sustained.
We're very concerned it will be more sustained, and I think key to that is how wage behaviour responds and how inflation expectations respond to that. On that, the longer-term inflation expectations, University of Michigan aside, do seem to be well anchored at the minute. Whether that remains when consumers actually start seeing the price rises in the supermarkets, as we said, there is a lag, remains to be seen.
We had the China data out today. Headline, GDP is looking OK. Exports are humming along nicely. The consumer, though, is under pressure. House prices are falling. Yeah. Link what's happening link the Chinese economy to Europe and whether or not we can expect China in the second half to be a demand driver for European manufacturing as it has to divert away from the US.
Yeah, that's a difficult question, because although the headline data, as you said, was very good and it shows that China is on track to meet its 5% target, I think there were warning signals in that data. The retail sales data was weaker than expectations, and that really shows that the consumer trade-in program, which has been boosting retail sales for the last few months, has started to run its course, and that is to be expected. How many washing machines can one buy? Once you've traded it in, you're kind of done with that. So there is concern there. The property sector is still dragging on economic growth in China. And although we are seeing that China has managed to replace some of its exports to the US, to the rest of the world, if the global demand backdrop weakens, that's a problem there as well. So we're quite nervous on Chinese growth moving forward.
OK, nervous on Chinese growth. Ellie Henderson, thank you very much indeed. 3.75 is the rate that you expect from the Bank of England by the end of this year. And tariff impact on inflation stateside, as we count down to CPI, of course, out late today, potentially stickier than some expect. Ellie Henderson, economist at Investec. Now, Tesla is opening its first showroom in India as it looks towards new markets to offset slowing sales where it is already well established. Bloomberg's Alisha Sachdev joins us from the showroom in Mumbai. It's been a busy day for you, I know. How significant, then, is Tesla's move into India? Is this the first openings?
It is indeed the first opening, the first of two experience centres that Tesla will have in India. One right here in Mumbai behind us, which was inaugurated today, and another one which comes up in the national capital, New Delhi, later this month. It is a significant move as far as Tesla's formal entry into India goes, but it is a fairly cautious and measured step that Tesla has taken, especially considering how the Indian government has really made local manufacturing the central plank of its industrial push. The fact that Tesla is only choosing to import cars and not manufacture locally is not something that the political dispensation here will appreciate too much, but it is a first step and a cautious one at that. But we'll have to see from this point on how customers really react to the very high prices that Tesla is proposing due to the high import duties for the Model Y it's bringing here.
Talk to us about what seems to be what's been characterised as a rather low-key approach by the car maker as it tries to put its feet into that Indian market. What is behind the relatively modest push into this huge consumer market that is India?
Well, as we know, Tesla for years has been trying to negotiate lower tariffs on car imports from the Indian government, and it has so far not got its way. There are, of course, trade talks with the US and with the European Union in discussions. But for now, what Tesla has to pay up is a steep 70% import tax on the cars it imports, and that goes up to 100% for cars above $40,000 US. That is what is making Tesla apprehensive. There's going to be a fairly limited market for EVs that are so expensive. The domestic competition, of course, is very intense too. And the homegrown automakers offer cars for the mass market at a fraction of that price. So the test is really to be able to gauge how much buzz the organic brand pull can generate, and how much that will then translate into buyers willing to pay a very steep premium for these cars. Remember, the Model Y here will cost the base rear wheel drive for the Model Y will cost about $70,000 here, which is more than about $30,000 more expensive than it is in the US. So that explains the caution to a large extent.
Wow, I mean that's a huge jump, isn't it? $70,000 US, $30,000 more than in the US, given per capita income. That's pretty remarkable. I mean, who's going to buy these, and what are the big questions that Tesla faces then in India going forward?
The first one, of course, immediately for Tesla to address is the price. Now that we know the prices are going to be steep, we know that it's going to be competing with the luxury car manufacturers in India, which is a very small market, just about 50,000 units or 1% of the annual volume that passenger vehicles do in this market. So the buyer is going to be your aspirational luxury customer. But even so, these are new cars, and EVs are only about 5% of the Indian market too. So there is bound to be some apprehension, but we will see that the brand will pull some customers along. It was back in 2016 that Tesla first started taking bookings for the Model 3 from Indian customers and never ended up delivering them. The other questions that Tesla will have to address are, of course, the policy angle. Tesla will have to sort of see if there is a favorable trade deal that works out with the US and EU, and that could allow it to import more cars into India at a slightly friendlier import duty. And the big one, of course, is eventually whether it will consider manufacturing locally, which is what the government has been pressing it to do all along. And that will be a function of how much demand it can get, whether there will be an India-specific model or an affordable model that Tesla brings into its lineup, and whether diplomacy can also offer it favorable trade terms. So those two things coming together will really decide its next moves.
OK, excellent reporting for us. Bloomberg's Alicia Shajev in Mumbai on the opening of that Tesla showroom, of course, in the financial hub that is Mumbai. Alicia, thank you. Coming up, Wall Street's largest lenders beginning reporting earnings today, with JP Morgan and Citigroup first on the list. More on what to expect from US banks. That's coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Wall Street's 6 biggest banks kick off earnings this week, with JP Morgan and Citigroup set to report later this morning. Bloomberg's Charlie Wells is here with a preview of what to expect from the bank earnings picture. Charlie, what are you going to be focused on? What are the analysts saying is going to be driving their attention?
Well, Tom, there are some really high hopes going into this earnings season for these Wall Street banks. I want to show you a little bit of that optimism going into here. If you take a look at that KBW bank index of these major American banks, you can see that it is actually this year outperforming the Nasdaq 100. So a lot of optimism going into this earnings season. If you take a look at some of the factors that we're looking out for, it's that trading revenue that is really expected to boost these banks. There's been a lot of volatility in the markets. You're seeing on that fixed side some leadership coming from Citigroup reporting later today. And then on the equities trading side, we're looking at Goldman, who's really been outperforming on that equities side. So the volatility really boosting these trading desks. If you think about net interest income, that is also really helping a number of these banks. That is the single largest revenue source for a number of these large majors, bringing in billions and really holding up in this higher for longer environment. But it's going to be something of a mixed picture when we think about investment banking. Of course, a lot of this uncertainty has been bad for deal making. So a mixed picture on that investment banking front.
How much of the performance in terms of the share prices for the banks is already reflecting expectations that earnings will be solid this quarter? How much essentially is already priced in, Charlie?
I mean, Tom, that really is hitting the nail on the head here. When you look at the screen, you see so much green here for these individual names across the board year to date. A lot of optimism, but this kind of masks a divide that we're seeing in that Wall Street analyst community. I want to bring up some commentary from a number of real top analysts here indicating a divide and kind of some of the thinking here. So if you think about Mike Mayo at Wells Fargo, he's really on that more bullish side, saying that as long really as there's not a recession, really there's a lot of room to run for these banks, using the phrase giddy up here in regards to these Wall Street banks. So optimism on that front. But there's another take here, and I think this is coming through in Saul Martinez at HSBC, taking a note of caution here, really talking about how, we need to pay attention to some of this macro uncertainty. Let's take a look at how this analyst divide is playing out in individual names, with, say, JP Morgan reporting in just a few hours. About half of analysts giving this a buy rating, but a more cautious and more optimistic take from the other half.
Giddy up. All right, indeed. What gets in the way of the banking rally? What are potential headwinds at this point, Charlie?
So there are a number of concerns that we saw kind of play out earlier this year. These trade tensions, of course, these negotiations are ongoing. There's that macro uncertainty that Martinez at HSBC was talking about. But I also want to bring up this chart, and I think this speaks to an interesting fact that we've seen in this rally, that KBW National Bank Index really outperforming. But when you take a look at the regional index, you see not a strong performance here. So this indicates that some of the strength that we've been seeing from these big Wall Street names really coming from the market. But there's questions about consumer health. Some of these large banks have talked about setting aside more money in the event of soured loans from the consumer front. So I think looking deeper beyond some of these optimistic numbers were coming from Wall Street, coming from markets, giving a reality check to some of those high hopes.
OK, if you didn't know what to watch for when it comes to these bank earnings, you do now. A brilliant breakdown breakdown by Bloomberg's Charlie Wells. Other bank earnings dropping, of course, later today. We'll have full coverage of that for you. Charlie, thank you. Now, and some other stories making the news. This Tuesday, the French Prime Minister is to outline a plan today to sharply narrow the country's deficit, setting the stage for a parliamentary battle that risks triggering another government collapse. François Bayrou will present around 40 billion euros of spending cuts and tax increases for next year as France looks to shrink the euro area's largest budget gap. Volvo Car says it's taken a $1.2 billion impairment charge because of delays to some of its electric models and the rising cost of tariffs. It says it will no longer be able to sell its ES90 sedan in the US profitably because of the import taxes. Volvo Cars shares are down around a quarter this year. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. So, President Trump came into office promising to end the conflicts and Russia's invasion of Ukraine, quote, on day one. Clearly that did not happen because diplomacy is difficult. But he has managed to move the dial, the needle, in the last 24 hours or so by announcing potential sanctions or tariffs. What we know is that there will be significant financial penalties. That is what President Trump is promising after 50 days if Russia doesn't conclude a ceasefire with Ukraine in that time frame. We're potentially looking, it seems, at sanctions on the partners of Russia when it comes to the purchasing of Russian oil. And it has moved the odds in terms of the poly market odds pricing of a potential ceasefire. Still very low, of course, but the needle has been moved on the back of that Trump announcement. Russia and India in focus in terms of those oil purchases. Let's flip the board and have a look at something very different, which is the UK retail's data, which dropped just after midnight, and there was a better than expected pickup for the month of June. The weather is part of it. People are going out and buying barbecues and leisure goods here in the UK, lifting retail sales then for the most recent data print. And you put that together with other early economic indicators suggesting that things are starting to turn around, potentially here in this UK economy after contractions in both April and May. All of this leading up to the Chancellor's speech, of course, Mansion House later today. Let's flip the board and have a look at the inflation print expectations for the Fed. CPI, this is the big data print of the day, of course, arguably of the week, dropping later today. We'll have full analysis on a headline basis year on year, expected to tick up. This is expected by many economists to be the first print that will reflect that tariff impact. On a headline basis, then, you're looking at a print at 2.6%. The core, and this is essential, obviously, 2.9% is the estimate. You're currently priced at about a 60% odds of a Fed cut in September. The inflation data, of course, out late today stateside, could be instrumental in changing and adjusting the pricing around the Federal Reserve. Still pricing in just shy of 2 cuts by the end of this year. Now, Bloomberg Terminal subscribers, of course, can get access to these charts and others used throughout the show at GTV Go on the Bloomberg Terminal. Alistair King, the Lord Mayor of City of London, will be on the pulse later this morning ahead of the UK Chancellor's Mansion House speech tonight. The opening trade, though, is up next. This is Bloomberg.